It's a real pleasure to have with me Ronald Redfield, who heads the Investment Management Division and is the Chief Investment Officer at RBCO. Ron is a true value investor, and so we're looking forward to hearing about his approach in this conversation. Ron, perhaps before we delve into all the value investing topics, maybe you could just tell us a little bit about your firm. I know you've got some 40 million or so under management. When did you get started? And tell us a little bit about your client base and how you run the firm.
Sure. So the name of our company is Redfield Blonsky and Company. So actually not RBCO or RBCO as you mentioned, although sometimes we use that as a pseudonym. I graduated at Syracuse University in 1981 with a degree in accounting, and worked for several CPA firms, and in the mid-'80s had a specialty in business valuation for various reasons, be it a buyout, employee buyout, maybe value of the business for estate planning purposes or for selling the business, and I developed what I thought was an expertise there. I then received my CPA, and eventually it turned into, I figured I could, why not use my same methods, and since I liked investing so much, use them to try to pick investments on publicly traded companies, and that's how that evolved. So I have a pretty strong financial statement analysis when we do our looking at investments.
So I assume it was it then out of your expertise in accounting and valuation that you really evolved toward the value approach to investing, or had you embraced that even before you really had the accounting related career?
Sure. First came the accounting, and doing valuations, I didn't know it, but doing a lot of I guess what now is considered value approaches. But I did not know that at that time. I don't recall ever reading Benjamin Graham or Buffett or anything like that. But as I got older and developed a client base, clients used to ask me for casual investment advice, and I would give it, and we'd talk about it, and I'd review some things, and then I started reading about investing and reading all the classics and so forth, starting to read, and decided this is what I wanted to do with my career, and I was given the opportunity to do so in the early to mid '90s, as some clients actually let me manage some of their monies, and that's how that developed. I also, as a side note, I don't know if this matters, but remember, I read this book called Brian Tracy's Psychology of Success, and in that book, basically, it's almost a byproduct, or obviously Brian Tracy, I would imagine, was influenced by Dale Carnegie and How to Win Friends and Influence People. But what I learned from this course or book was that if you spent an hour a day, early in the day, studying something you loved, but not necessarily what your current job was, you could develop, you could become an expert at some point. And the more you put in, the more an expert you'd become. So I used that method, and all of a sudden I really enjoyed investing. And since I had to spend an hour a day researching something, I just started researching investing and researching Benjamin Graham and so forth. Then it became to the point where I was no longer doing it an hour a day. I was doing it for many hours a day. And when I got home from work and so forth, and I remember my wife was not too appreciative that I was spending so much time doing this and working very hard as well as on my job. And I said, you know what, I think it's worthwhile. I think it's going to pay off. And now we're 21 years later, let's say, and I'm very happy with what I do and how this all developed. And I definitely think it started with the Brian Tracy, and then just continually to study. So to answer your question, I didn't intend to be a value investor, but as I was reading about it, it just made total sense to me. And really, no other investing really makes sense to me other than investing per se. But that's such a vague term, and is it really value investing that people are doing or not? And that's how that evolved.
Interesting. Well, you mentioned Brian Tracy and Dale Carnegie. Obviously, I think a lot of people have been really helped by those kinds of lessons and books, especially when it comes to building your own investment firm. I think there are a lot of ups and downs and struggles, and how do you attract the right sort of clients. You've been doing it for, I guess, a couple of decades now, so could you share a little bit about what you've found to be some of the keys to your success in terms of attracting and those clients and building those relationships over time and kind of growing the firm over what by now is a pretty nice long track record?
Right, and actually we started. I started officially in 1997, January of 97 or December of 97 is when we have our first official year where we track ourselves. And on the other hand, we only have $40 million of management, so our focus, even though our performance has been fairly good, our what do I say? My focus has not been on growing the business and so forth, and sometimes I question if I have been successful or not. But anyway, to answer your question, well, we grew the business first by clients. I was always enthusiastic in accounting, and then they saw how I was enthusiastic. The same clients saw how I was enthusiastic about investing. And after talking to us for a number of years, a few started joining us, many and so forth. From then, it was really a lot of word of mouth, or if they just, but basically word of mouth and somewhat performance. And we also have when you said ups and downs and so forth, we really didn't have any downs until the financial crisis, and that was quite a humbling and difficult as well as educational period, where I just think I learned so much about how to improve things and so forth and what to focus on. Does that answer the question? Or?
Yeah, definitely. I guess I would just ask, since you mentioned 40 million, the number that maybe it's not a big number, but I think for some folks it would be a nice number. So maybe you can just tell us a little bit about the fee structure. Do you charge performance fees? Is it separate accounts that you manage? Is that right?
Yes, we only manage separate accounts, and we charge typically we charge 1% of managed assets, and we bill that on a quarterly basis. And that's how that works. We have no performance fees whatsoever.
So it's the classic kind of asset management fee structure.
Yeah.
Got it. Yeah. So, I see your investment philosophy description here, and you say on one hand you're value investors, and on the other you're focused investors. So I'd like to just explore a little bit what you mean by focused investors. Are you talking principally about the concentration of the portfolios, and is it in that regard?
Without a doubt. That's perhaps I'm using the wrong term when I use focus. Although I remember the book Focus Investing, but yes, it's certainly a concentration of positions, or that's what we try to do: concentrated positions, if we feel the time is right, and so forth. Sometimes Sometimes we might have 25, 30 positions. Sometimes we might have 15 positions. Right now, we've been reducing our positions, and I guess this happens just over time as we see, maybe one of our core investments where we want to own more of it, and so maybe some other investment either hasn't lived up to what I'm hoping for, or has achieved perhaps a target, or we see investment A where we want it, we just want to own investment A, so we have to then sell investment B to get that bigger position. Right now we have 3 positions that probably make up somewhere between anywhere from 35 to 50% of anybody's portfolio. All portfolios are somewhat different, and it all depends on just how I think a specific portfolio should be allocated, especially if one has a less conservative profile. I feel more comfortable putting in greater position sizes on those.
And I see here you have a nice chart that shows your top 5 holdings by year.
Yes.
And in the most recent, or I guess as of the end of 2012, National Western Life Insurance, Microsoft, PSEG, Pfizer, and JP Morgan Chase. So I guess most of those names will be familiar to folks, but could you maybe explain a little bit about the rationale? Let's not go into each company specifically. We can do that a little bit later, but just in terms of how you think about the structuring the portfolio, and do you want to make sure that you don't have more than 1 or 2 companies in the same industry? How do you think about kind of the risk side of the portfolio?
That's an interesting question. I'm looking also now at our top 5 holdings, and still National Western's the first, Microsoft's the second. Let's see. Exxon is actually third, where it wasn't even in our top 5 list. Public Services fourth, and Pfizer is now sixth, or fifth. I don't even need to mention, but so often I don't know if it's on purpose, but we will diversify industries somewhat. I'm trying to think I don't know if there's a pure. I don't think I'm doing that for any defensive reasons or so forth. Maybe it's just the way it just turns out, is where our research is. If you look at our holdings from years ago, we weren't always as mega cap as we are now, or big cap as we are now, other than National Western Life, which is under $1 billion company, and at one point last year was probably a $300 million company. But right now, in some of the mega cap holdings, we're just seeing what I think are really attractive valuations, and as well as attractive, and then there's liquidity, typically attractive balance sheets, and then we just trying to stay safe, and we're able to do so with the big cap names when that's in investing isn't always the case. Normally, my observation has been you typically have had to pay for big cap, and I guess that changed over the last decade as the Walmarts and the Microsofts have stayed at Walmart until recently has stayed at essentially the same prices they've been at for the last decade. And then we have National Western Life, which is a different, totally different animal. And we have a high concentration there primarily because we're looking for we found a conservatively run company, one with great longevity, conservative business practices, and so forth, and a price to book value that was just very low. And then when you compare their price to book value to others in the industry, I feel it's even lower because they have mostly they have a 7-year, let's call it a 7-year AA portfolio, a bond portfolio, and whereas most insurance companies report that portfolio at fair value, available for sale, they basically record it at amortized cost. So you even have a greater discount to book value than what appears when you're comparing it to, let's say, a MetLife or any other life insurance company.
And I'd be curious how you gained comfort with it. You know, insurance companies often are a little bit of a black box. It's hard for an outsider to know if their reserving is conservative, and also how the folks there are compensated for writing new policies and things like that can really have a big impact on long-term value. So maybe you could tell us a little bit about what got you to the level of comfort that you made it your biggest holding, and based on what you said about the concentration, I assume it's around 20% or something on that.
Right. It was at 20. We brought it down to probably 15 or 13% over the last 3 months or so, 4 months, 5 months. I'd have to look at our order flow, but and the reason we did it is because we were accumulating heavy in the 120s, low 130s, and then finally when it went to 160, 170, 180, we wanted to take off some of the excess. But nevertheless, it still remained, even after trimming it as much as we're going to trim it, basically, until more information comes out, if anything changes. It's pretty much at our desired position right now. And then reserving is very interesting because I speak to so many investors, and everybody says basically the same thing, and it's certainly a true statement. Yet so many professional advisors own Berkshire, and you have no difference in Berkshire. You know, a lot of Berkshire is based on the reserving and so forth, and somewhat of a black box that we don't know about. You know, we know about their public companies, but we don't know about Geico, and we don't know about Dairy Queen and so forth, all their smaller companies and so forth. So a lot of it is black box and faith and so forth. Well, so the same thing goes with National Western Life. And not to say nothing is without risk that I see. I'm not familiar with anything without risk, but we try to identify the risks. And what you have with National Western Life is you've had have a company that's been around doing exactly what it does since 1956. So I've read all the reports, annual reports from 1970 onwards, and very interesting enough, I forget how, there were only so many reports we can get online, and then I went to the library and so forth, or Edgar, and got a bunch of other reports, but there was a huge gap missing, and we contacted the company, and they eventually put on all the reports. I don't remember if it's somewhere from the early 1970s onward. They put on all their annual reports onto their website, which was pretty neat to see. But they have so what do? I looked at National Western Life, and their business operations have not changed a great deal in the 58 years, however many years they've been around. Things have always generally what they say will happen or how they describe in their annual report often seems to occur. And I would think the black box gets a little more clear, I think, with each year going by. And when you have a company that's been around since 1956, I think their track record somewhat speaks for themselves. You also have heavy insider ownership. You have the president and CEO, or Mr. Moody, owns 37% of the stock. So we feel that he, has skin in the game and is looking out for his company. Sometimes investors look at that as a negative, but we typically see that as a positive. The reason they look at it as a negative is because the company seems to have a great ability to pay dividends, but chooses not to. And unlike Berkshire, they're not reinvesting with a great return of capital. So they're reinvesting. Their reinvesting is questioned by investors. But we're okay with what they do in reinvesting because they're reinvesting in their business, and they're just looking to grow and try to keep a solid balance sheet and so forth, which they have been doing. They're one of the rare companies that was upgraded by AM Best during the financial crisis because they have what they call a fortress balance sheet. And if operations stay the same, we expect that to continue a great deal. And we've seen some things in the industry which lead us to believe that they are more conservative than other insurance companies, the way they write off certain costs where others would amortize them over time. And when there was a rule change and a lot of insurance companies had to take a charge to readjust to the accounting rule change and to expense greater costs than to capitalize them, National Western Life did not have to do that. I believe it was 2 years ago, fiscal 2011, maybe 10. I think it was 11. And they did not have to do that because, quote unquote, they said they always followed the most conservative reporting, and that's why they did not have to add back any charge. They were already doing that. Their compensation practices, going from memory, a little excessive, but not to the point where we won't invest in them. I forget, it's on our website or on our notes, but I forget what Mr. Moody makes per year. Maybe $1 million or so. I really don't recall off the top of my head. But he's not paying himself Buffett-like, but he's also not. I don't think he's certainly not taking too much from the company. I'm trying to find that number now, but.
So it sounds like you essentially saw what was a good insurance company, maybe not the best there is, but certainly good enough, and they've been around for a long enough time to give you some comfort with their reserving and track record of operations.
I wouldn't even say they're not the best there is. They're a fairly solid organization. I'd have no issues getting a life insurance policy from National Western Life.
Yeah.
You're going to get paid. The capital deployment people question, but the reason they're such a strong company is they're deploying their capital right back into the business. So one argument is, why sell a life insurance policy or an annuity that gives you, at best right now, a 6 or 7% return on equity when you can, invest in, buy back your own stock when it's selling at 40% of book value and get a greater return on equity. Well, they choose not to. And that's the part we respect. They claim, and I believe they choose not to just keep their rock solid balance sheet, and their stated main goal is just to keep their credit ratings their insurance ratings very strong.
Mm-hmm. Good. Well, maybe we could switch gears a little bit and talk about, I guess, the risk management that you employ when you have the kind of concentrated portfolio that you have. Do you like to hold some cash in the portfolio as well, or do you tend to be fully invested?
That varies period by period or era by era. Right now, we are and probably have been for the last year or so, maybe even longer, fairly fully invested. I would love to have powder dry powder for making more investments. But up until recently, and even now, I mean, we were buying things today, um, and even yesterday. Um, um, so yeah, I think it's always that's one of the dilemmas I have is that we do not have high cash positions right now at all, really next to none. So there's no dry powder. But on the other hand, if I like the investments we have, and if I may, it's a no-brainer for me if if an account opens today or somebody sends in money today, there's things I'm buying for sure. Not as much as I was buying 6 months ago, and then not as much as a year ago, but we're still sitting on very little cash, and don't anticipate that to change so quickly. And over the short term, that could work against us, especially if there was a stock market correction. We would feel it more than normal.
That's interesting. So you're still seeing bargains, and I guess you've been. Is it fair to say that you've tended to be fairly fully invested over the years when you've been able to find ideas? I mean, it sounds like you're not really dogmatic about having some kind of a cash position.
I have no objection to cash. It was a lot easier to hold cash or temporary investments, temporary fixed income investments when interest rates, let's say in the days when you could get 5% on a 5-year CD or something, and there was more alternatives. So now we lose that alternative. So when we didn't hold cash in the past, we felt, even though it could backfire, we felt that our fixed income positions and so forth were low enough duration, high enough quality that we could always trade out of them and turn them into quick cash, even though they were not quick cash. You can't compare cash to anything other than cash, I guess. Certainly can't compare a 3-year or 4-year Treasury with cash, but we did always keep the money working for us. Now I don't keep the money working. I really don't keep a lot of cash around. One, because until recently, what I thought were great valuations, now they're okay. And two, you're just not getting paid to hold the cash anymore. It's a very difficult phenomena with short-term interest rates near zero. It's very difficult, especially for one who is at the end of their career, so they're no longer making money. But yet, how do they invest? What if there is an issue? What if there is a black swan event? But to answer your question, just not holding cash right now, and we have held it. So I'd say that we're at the lowest cash position we've ever been. And even though we weren't holding cash, let's say 5, 6, 7 years ago, we were holding what we thought was easily liquid, and always proved to be liquidity that did pay us to hold it. You're following what I'm saying, right? Or am I
Yeah, absolutely. Do your clients look for income from you at all, or are they just looking for long-term capital gains? I guess what I'm getting at is, do you go out and try to find stocks that have attractive dividend yields?
Do we go out and try to find them? Well, right now, and especially in lieu of not being able to hold cash, we are definitely focused on doing our best to create a dividend, to create a yield. But of course, we have one company that's a very small position we don't know so well, very high dividend yield, but it's a very risky position. So the dividend yield is not necessarily sustainable. But on the other hand, we do have a great focus on dividend. I'd have to look at our average dividend yield right now on our holdings of our portfolio. I'll get that up while I speak with you. I'm sorry, let me just.
I think so Pfizer. Yeah, go ahead.
we're certainly focusing on dividends, but we're focusing on well, we look at it all together because we're looking at it unlike that risky situation with a high dividend, which could terminate or seriously decrease. We want to find a sustainable dividend even if and when recessions hit, recessions and even depressions. So that's why we like, and Pfizer, I guess, fits that bill. Probably a little more aggressive. Same thing with Merck. But then you have, low payout ratios from companies like Microsoft, Exxon, ConocoPhillips. So we see, not only do we see a fairly decent dividend yield, one that destroys the 5-year treasury, but also an ability to be able to sustain or even increase that dividend over time. So it's certainly an added cushion and an added margin of safety, as you know. And it looks like our average dividend yield right now is somewhere around 2.5 to 2.6%. We also have a big focus on utilities right now. Well, not right now. It's been that way probably for close to a year or so. Big part of our portfolio. So we probably have a good 25% of each portfolio in various utilities, which would include public services. You see one of our top 5 holdings.
And what is it about utilities that attracts you?
Okay, well, utilities are it's very often regulated, although most of the utilities now are let's say 50% regulated, 50% unregulated. At this point, we all need electricity and so forth, so utilities are, I feel they're a more defensive position. Certainly not an alternative to cash, but as close as we could come to the old time when we the old days when we owned let's say 3 to 6 year treasuries or such, AA, AAA bonds as a cash alternative. Always knowing it's not a cash alternative because things could mess that up. And we're doing the same thing with utilities. I think the utilities are somewhat misunderstood right now because the price earnings ratios are a little bit higher than normal, but we're not seeing them out of the park higher than normal. But what I do think will happen is that utilities price to their customers, you and I, and businesses and so forth, based on the price of natural gas. Well, natural gas has, over the last, 6 to 10 years, I'd have to look at our site also at a graph natural gas prices basically crashed. Over the last year, natural gas has slowly has increased over 120%, I believe, and that's not yet reflected in the pricing structure of the utilities. And I think once that is reflected, that you'll see earnings of utilities go up, and they don't have to go up a lot to bring their PE down 1 or 2 points, and then all of a sudden you have a PE of 11 instead of a PE of 13 or 14. And I think more of their normalized earnings will be a higher return. But even in utilities, we're trying to focus on the financially stronger of all the utilities, ones that can, once again, weather bad things happening. And a lot of bad things have happened to utilities as production has gone down because of the crisis and the recession, because of foreclosures and so forth. And I think as the economy continues, that will change somewhat, and it might be a slow process, but I think you'll start seeing quarterly and annual profits to start going up again to more normalized levels.
And since we're speaking about industries a little bit, are there industries that you try to avoid either because you feel like they're outside of the circle of competence or because you just don't like their economics?
I don't mind difficult. So where a lot of value investors put in the too hard pile, I'll try to go at it. Often I find my skill as a CPA benefits there. Are there certain industries that I'm not real comfortable with, just because of my circle of competence, and I'll tend to shy away from them. Probably retail is the biggest. Retail is the biggest example, and hence our only real retailer in our portfolio is Walmart that I could think of. When there's a lot of always have been good ideas in the retail sector, it's just not what I feel comfortable with. Same thing with restaurants. For some reason, I just can't seem to invest in a restaurant. I just don't feel comfortable with it. I go to restaurants, I just can't invest in them. Other than that, each client that hires us, I let them know that we do our best to be socially responsible in investing. But I also make them let them know that social responsibility is very subjective, because I would be totally fine and actually search out to own a beer company, which we do not own. Some people find alcohol to be terribly irresponsible. I don't, as an investment. So it's very how convenient. I can own a beer company, but on the other hand, there's no way I would ever own a tobacco company. It's just not within my framework. But many people would find that to be odd or incorrect. But that I make it clear to clients or potential clients, this is something you're getting. You have to understand, and you might, we could see a tobacco company that would have a no-brainer 100% gain, and I'd probably wouldn't even touch it. I used to go with the theory, if I can't show the kids the annual report, I don't want to buy the company. If I felt uncomfortable with it. Although one of our early most profitable investments was Philip Morris, but that's when they were still, if I remember correctly, a beer company as well as a food company with Kraft and Nabisco.
Mm-hmm.
But I sorted it out in my own mind, saying, "Oh, it's only 50% tobacco." But then once they split up, we dumped it and never looked back.
Yeah. Well, I think that's certainly admirable, and also I like the fact that you don't kind of use some rigid definition that somebody came up with, but just kind of decide for yourself what you're comfortable with and what you're not.
Well, if I may interrupt, one of the most I looked at Walmart. I'd have to look at my notes. Many years ago, probably 5-6 years ago. I don't know. Time really flies, but and I wanted to buy the company, but I was very concerned about their accusations of social irresponsibility. So I spent quite a bit of time, probably 2-3 weeks, researching are they socially responsible or not, irresponsible or not, like everyone claims and still claims. At the end of the day, I found my conclusion, and my conclusion remains, is I feel there's a pretty good organization. Morale of employees not as bad as everyone would anticipate, and I think it's a great organization. I think they are socially responsible, although the world says otherwise. But they're always going to be criticized as they're the biggest employer in America, if I'm not mistaken. So they will be criticized. By the time I finished back then my review of it, the price had gone up maybe 20-30%, and I no longer wanted to buy it. Once the price went under 40 or in the 40s several years ago, I had the opportunity to buy it, and that I was felt very comfortable with their social responsibility. Yep. Although we have had several clients that really requested that we sell it, and we did. They just didn't want to own it. Huh. That happened also with a company that we no longer own, and hopefully one day will again, is News Corp. Same thing. Certain people just don't want to own News Corp.
Huh. Interesting. Well, I think what folks sometimes kind of overlook with a company like Walmart, it's easy to see maybe if the employees are underpaid or there's some issue there, but people forget how many other folks, actually millions and tens of millions of people, are benefiting and actually having a higher quality of life because they're able to afford more things thanks to Walmart's efficient operations. So maybe people who are kind of on the edge of poverty and wouldn't be able to eat enough can now eat enough because of Walmart, and that doesn't, I guess, doesn't make it into the headlines, but that's
Right,
the
and
other
I
side.
agree. But I also think their competitors, be it their the major supermarkets, Target and so forth, their prices are probably have to be naturally lower to compete with Walmart as well. So it's not just a Walmart shopper that would benefit from this. How much different is Target pricing? Probably not that much different.
Yep. Yeah, they in effect force the industry to offer those kinds of prices. That's.
There's a joke among my friends. No one aspires to shop at Walmart except Ron Redfield.
Or Sam's Club, I guess.
Yeah, well, we don't have one close to us. So,
okay.
It's kind of funny that I have heard. And my wife makes fun of me. She hates Walmart, but
yeah. So it's interesting that you mentioned the kind of some clients actually requesting to remove some stocks from their portfolios. I guess they have fairly regular reporting then, or can access their account at any time online or something. Is that?
Oh, without a doubt. Most of them access it online as well as get monthly statements and confirmations, be it electronic or snail mail. There's not many that it's very only a select few that will limit us from things like that, or really request that we. Very rarely would it be a forced sell. But why give them discomfort? If someone doesn't own Walmart, especially when it went up to 75, someone said, I really don't feel comfortable, let's get rid of it. I talked to them a little bit, and they say, no, I just don't feel comfortable. Fine, we'll be done with it. It's fine. It's out of your portfolio. And we make it clear if I ever buy it by mistake, I apologize. We'll probably do the same thing. It's happened very rarely, but it has happened.
Yeah.
And it's happened with It's even happened. Well, I don't want to. It's happened primarily with Walmart and News Corp, and I guess those are politically active people that have strong feelings and so forth. But and just like even with News Corp, they certain will get concerned with their politics and so forth, and maybe Fox News. I'm like, well, it's. And they'll blame Murdoch, and I'm like, is that Murdoch, or is it Murdoch, or is it the head of the news? That's what they do, and just they don't want to. They want to do what they think is fair reporting. You have plenty of other reporting to go to, and then we'd explain, News Corp. Well, they also own the Wall Street Journal and Barron's. That's a fairly good source of information, and if they were so bad as you think they are, would they really be? What do they own? The Family Guy and Simpsons. It's not. You're not gonna. You're never going to be a perfect situation. Exxon's the same way. People hate owning Exxon. Well, we all need our oil and gas. So.
So, what are there any other things that you've kind of learned over the years in terms of dealing with clients and making them happy that that only come with experience that you've kind of had to get used to?
No, I think before we accept a client, be it a very large client or a very small client, we really have no minimum per se, depending on their situation. I let them know all about what we do and what we don't do. I'll let them know we'll do our best to build. Here you have a potential portfolio underperformance because we won't invest in certain things that we feel are socially irresponsible, even though we might be incorrect in that assumption. It's just a feeling, or we might own something that. You don't want to own such a Walmart. So if that happens, I'm sorry I bought it. Let's talk, and if we can't come to terms on that, we'll typically eliminate it from your portfolio. Now, on the other hand, if a client says, and this happened quite a bit last year, I want to buy Apple. Well, we just don't feel comfortable. We don't own Apple. We own a select group of companies, and those are the ones I own. And I really don't want to think of put anything else into it. So they'll maybe get a little concerned, but I'll say, we just don't own Apple. I'm sorry, we can't own everything. It might go to 2,000, it might go to 200, which is just not what we do. So you could always, and we say this quite often. We say this also with fixed income. There's nothing wrong with fixed income. It's just no reason for you to have us invest fixed income in this environment. So you figure out how much fixed income you want in your portfolio. Let's say you have $1 million portfolio and you want $200,000 of fixed income. We'll free up $200,000. We'll send it to you, and you can invest it in a CD somewhere. So we just make ourselves very clear with clients. We are what we are, and you're hiring us for our expertise. And typically, we're always open to speak, just like you and I are now. But I'm not gonna change my principles just to save our revenue or our client, unless they have a real, there's always an alternative. There's always a way to help them achieve their goal. And I think something rare, and advisors have heard this from us, where we say, just like I told you, take a 20, 30% of your portfolio and open up CD somewhere. And if you ever want to bring it back, you bring it back. And people are just amazed that we would do that. Why would you let the assets go out the door? Well, that's, I think, the best thing to do, and just to be honest and level with them, and then everybody has a comfortable situation.
Well, that's interesting. I think it's counterintuitive, but probably in the long term ends up engendering a lot of loyalty and trust.